For decades, the United States has been treated as the center of the global economic universe. The dollar sets the rules. American markets move the world. And when the U.S. economy sneezes, everyone else catches a cold. That belief still exists. But something uncomfortable is happening beneath the surface. The United States isn't collapsing. It isn't crashing. It isn't being replaced overnight. Instead, it's losing something far more important: control. Quietly, gradually, almost invisibly. And history shows that when economic grip weakens this way, the shift is already underway long before anyone admits it. To understand why this matters, we have to go back to where American economic dominance actually began. After World War II, the United States didn't just win militarily. It emerged financially intact while much of the world lay in ruins. Factories were untouched, infrastructure stood strong, gold reserves were massive. The Bretton Woods system locked the dollar to gold and tied global trade to American currency. Oil was priced in dollars. Debt was issued in dollars. Global savings flowed into U.S. assets. This wasn't accidental. Economic power became America's strongest weapon, and for decades it worked flawlessly. But dominance carries a hidden cost. When a system becomes too central, too relied upon, and too comfortable, pressure builds silently. The U.S. economy grew larger, but so did its responsibilities. Wars were financed with debt. Growth was supported by consumption. Deficits became normal. And then something changed. In 1971, the gold backing was removed. The dollar became pure trust. That trust held, not because of discipline, but because there was no alternative. For years, the system expanded without resistance, until cracks began to form. Manufacturing moved overseas. Debt outpaced productivity. Financial markets grew more powerful than the real economy. The United States still looked strong, but internally, the balance shifted. Economic power started relying less on production and more on leverage. The breaking point didn't arrive as a single event. It arrived as a pattern. Repeated financial crises, rising inequality, exploding debt levels. Each time, the response was the same: more liquidity, lower interest rates, bigger interventions. These fixes worked, but only temporarily, because they treated symptoms, not causes. Meanwhile, the rest of the world was watching. Countries began questioning dollar dependency. Trade deals slowly shifted away from U.S. settlement systems. New payment rails were quietly built, not loudly, not aggressively, just cautiously, and this is where the real shift begins. Economic grip isn't about size alone. It's about influence. When others start planning for a future where your system isn't central, your power changes, even if you remain wealthy. Today, the U.S. still dominates headlines. But behind the scenes, the patterns look familiar. Rising debt without long-term growth. Political gridlock over fiscal decisions. Financial markets disconnected from economic reality. These are not signs of immediate failure. They are signs of late-stage dominance. History offers uncomfortable parallels. Every global economic leader, from empires built on silver to reserve currencies backed by trust, followed the same arc: expansion, overextension, dependence on confidence, and confidence, once questioned, doesn't vanish overnight. It erodes, quietly. The most telling sign isn't crisis, it's adaptation elsewhere. When nations build systems that don't require U.S. approval, when trade bypasses traditional channels, when reserves diversify, the United States remains powerful. But power without exclusivity behaves differently. And attempts to regain control often backfire. Sanctions push alternatives. Rate hikes stress global markets. Debt ceilings shake confidence. Each fix solves today's problem, while weakening tomorrow's position. This is the paradox of modern economic leadership. The tools that built dominance are the same tools now limiting flexibility. And the future isn't about who collapses. It's about who adapts. The United States isn't losing its economy. It's losing its unquestioned centrality. And that shift matters more than most people realize. Because global systems don't break suddenly. They reroute, gradually, until one day, the center is no longer the center. 3 takeaways make this clear. First, economic grip is about trust and relevance, not just size. Once alternatives exist, influence becomes optional. Second, repeated crisis management without structural change accelerates long-term decline. Stability bought with leverage always comes due. Third, quiet shifts are the most dangerous because they're ignored until they're irreversible. The open question isn't whether the United States will remain important. It's whether it can adjust before the system fully moves on. History shows that empires rarely notice the moment they stop leading. They notice it when leadership no longer follows. And by then, the future has already chosen a different direction. If you want to understand where power is actually moving, not just where it used to be, subscribe to the channel. Because the biggest economic changes don't announce themselves. They happen quietly.